Could this be the most dangerous stock market bubble in history? Some experts think so, including one who just called this the mother of all bubbles. That sounds super ominous. Today I'm going to break down for you why they think that, whether it could be true, and most importantly, we're going to talk about what you can do to prepare yourself if in fact we're facing a market downturn of epic proportions. So where's this coming from? In a recent article in Financial Times, Ruchir Sharma, who's the chairman of Rockefeller International, stated that the U.S. market is deep in the mother of all bubbles. Here's what he means. The U.S. stock market has been on a tear for some time, and as that's happened, share prices, what it costs to buy a single share of stock, have gone up faster than the profits represented by that one share of stock. This is commonly called a PE ratio. You don't really need to know what a PE ratio is, but what you need to know is this: prices have gone up faster than profits have. There's a number of reasons this can happen, but generally speaking, if that continues long enough, a stock or the market as a whole becomes overvalued. Think here of too much optimism. Everyone is pricing things like everything's going to be great. There are more buyers than sellers. Bingo bango, prices go up faster than actual corporate profits. Normally what happens at some point is people look around and they go like, wait a second, this is way too expensive. I'm out of here. And they sell. And when enough of those people get that idea and the sellers outweigh the buyers, prices fall. If that happens enough and fast enough, we go from correction to bear market to crash. So this fella is saying we're on the edge of this taking place. He makes some compelling arguments. Now, I'm not a sky is falling guy. I've long said, no matter what you think, you can find some expert somewhere on the internet to reinforce what you believe. But let's look at some hard numbers here, because I think there is some validity to what he's saying. If we look at the largest global stock market index, the MSCI All World Index, currently US stocks make up 73% of that index. Here's the problem. The US economy only accounts for about 27% of the world's economy. For years, since coming out of the 2008 financial crisis, the US market has outpaced international stock markets by a long shot. Here's the chart that breaks that down. You can see that since 2010, the US market has more than doubled international developed stock markets. Now, that's the what. Let's talk about what it means. First things first. I've been around for 43 years. I've spent 20 of them, or a little bit more than that, in the finance industry. I'm yet to meet a person that can tell the future. So I'll say this: I have no idea if this guy is right. Guess what? He doesn't have any idea if he's right either. It's an educated opinion, but it's just that, an opinion. My dad taught me a saying years ago about opinions that wouldn't be polite to record and put on the internet, but I bet you know what it is. Now, Sharma makes some compelling points. Valuations are high, deficits are even higher. There's no question that at some point a major downturn will hit. But there's another saying. This one's about the market. The market can stay irrational longer than you can stay liquid. Here's how this applies. You can't make knee-jerk reactions and sell everything, because we've had high valuations for some time. Our share of the global stock market has literally been rising for the last 15 plus years. I just showed you that in a chart. All along, if you sold because you thought we were hitting a bubble, you lost. And so who's to say that it will not continue? Here's where it does matter. Well, you can't make a rash judgment to sell. You have to, must protect yourself and protect your future from the potential of a crash, not just from a crash itself. What I mean is this: I'm a financial planner. I help people build retirement plans, and a huge part of that is protecting them from the what ifs. I meet people every week who are riding high on the market. They've done very well in it, but now they're shifting to retirement. And I say it all the time: what works to get you up the mountain doesn't work to get you back down the mountain. It's a different financial system in retirement than it is while you're working. And the time to change how you operate in that system isn't when you retire. It's before you retire, like 5 years before you retire. Let me tell you a story. Years ago, early 2000s, I was working for a bank. There was a coworker of mine. I call her Jane. It's not her real name, but nobody wants to be put on blast on the internet. She retired. There was a retirement party. There was cake. She was going off to live her life and enjoy her retirement. You probably see where this is going. The dot-com crash happened. Now, for those who aren't familiar, the market peaked in August of 2000, and then the S&P 500 dropped for 3 years in a row. Really, it was dot-com, 9/11, and a telecom crash that happened all kind of back to back. But 3 years in a row, the market was down. The market didn't hit that August of 2000 number again until May of 2007. Now, I'll come back to that in just a second. But to finish my Jane story, Jane lost so much money in the market that Jane came back to work. She unretired. She didn't have a good financial plan because it didn't address what could go wrong. She had a big old pile of money, but she didn't have a plan. Warren Buffett once said, "An idiot with a plan can beat a genius without a plan." Her lack of a plan led to her retiring. So how do you make sure that that doesn't happen to you? Well, going back to the stock market, taking nearly 7 years to recover from the dot-com peak. Let's say you're planning to retire next month, or 6 months from now, or 2 years from now, or 5 years from now. What if you're too stock heavy? What if you got more risk than you're comfortable with? Take whatever time it is that you plan to retire, let's say 1 year from now. And let's just say that the market does tank. Sharma's right. And let's say it's a dot-com situation and it takes 7 years to get back to where it is today. If you were planning to retire in a year, that might mean not having the same amount of money until 6 years after you plan to retire. And so the whole "I'll just work until it comes back" thing, well, that's a plan, but it's a bad plan. If you're looking for a good plan and someone to help you build one, check out the first link in the description to see how you can use our Clear Vision retirement plan to create the retirement that you deserve. Otherwise, if you're within 5 years of retirement, here's the quick playbook. First up, assess the risk in your portfolio. How much of your portfolio is subject to loss, and historically, how much is that loss in a major market downturn like the dot-com crash or the 2008 crash? Is that an acceptable level of loss to you? If something like what we're talking about were to happen and you lost $200 or $300 or $500,000, would it impact your ability to retire? If the market dropping has the potential to stop you from retiring, one of two things is really happening. Either one, you don't have enough resources to retire and you're trying to thread a needle here, or you have enough resources, you just haven't allocated them in the right way. You've got too much of your life savings at risk and it has the potential to change how you're living in retirement. That's a bad plan. The second step, how much income will you need every month when you retire? Run a quick budget. This takes a little bit of legwork, but pull 6 months or 12 months of transactions off of your checking account and start seeing how much you actually spend on a monthly basis. Now, compare that to how much you'll have coming from guaranteed income sources when you retire. Will you have a pension? How about Social Security? How much will that bring in for you every month? Once you figure that out, compare those two numbers. Do you have a monthly income shortfall? For example, do you need $7,000 a month to live on and you'll have $4,000 a month in Social Security or pensions? That's not a problem, but if so, you got a $3,000 a month shortfall. Once you figure out what that number is, you need to figure out where it's going to come from. If it's going to come from the retirement assets, you've got to have a plan for how you're going to access it. And that plan needs to take into account lasting for 30 plus years, minimizing taxes, keeping pace with inflation, and being protected from market downturns. That's a whole lot of work in one little sentence. If you want to see how to do all of those things, well, that's too much for one video, but fear not, I got a bundle of videos about this. We call it bucket planning, and I'll show you exactly how it works right over here.